Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. It's Quincy Krosby. Thank you for joining me. It's Monday morning, March 27th, and this is The Talking Point. This is well before the market is due to open, but futures market up, back on the back of the news that Silicon Valley Bank, good portion of it, will be taken over by First Citizens Bank. The market always appreciates when a bank that is coming in from the private sector, obviously it's a public bank, but takes over a failing bank. And the reason is the market likes to see that the government is not involved. Well, most likely the government is involved somehow, just simply because First Citizens or any bank coming in and taking over a bank that has failed dramatically wants to have some backstopping in terms of their takeover. So it's not, I don't think it's completely private sector to private sector. It gets entangled. But nonetheless, this is good news. In terms of First Republic, the government may extend the facility that was set up where the banks overall can come and borrow. They may do something in order to give First Republic more time to have, hopefully is what the goal is, to have another bank come in and take over a good portion of it. The $30 billion that a consortium of banks going in that was brokered, by the way, by the Treasury Department and apparently Janet Yellen, that failed, as we all know. It failed. It just simply was not enough. So again, they're trying to give First Republic some more time and then hopefully have another bank come in and take it over, which would, again, be good news. The goal is obviously to contain this and not have this spread from one bank to another. So another piece of good news this morning, and that is that the flow of funds coming from the small and regional banks, from the depositors to the large money center banks, which have been declared systemically too big to fail, that has slowed. And that's good news, because what you don't want, as we've seen, is a run on the small banks and the regional banks out of fear that, the depositors who come in above the FDIC $250,000 insurance are left high and dry. So that has slowed somewhat, and that actually is good news for the overall tone of the market. One thing I do want to mention, however, on this call, is that what we saw last week on Friday with Deutsche Bank, waking up and finding Deutsche Bank, which, by the way, has operations like Credit Suisse all over the world, including the United States, in trouble. The insurance on their debt, right, and that comes via a credit default swap. That's what I buy, so that if there is a default, I get paid. That shot up. It became very expensive. When that hits the headlines, what happens is the entire banking system, running. Everyone runs from it. The hedge funds short the banking system, right? They bet, hey, this is not going to wind up very good. But during the course of the day, on Friday, you had Christine Lagarde from the European Central Bank saying the right things, that that the banking system in Europe is solid, it's resilient, there's liquidity, there's capital, and that they would be on guard if the banks were in trouble and needed help. But during the course of the day, on all of the media news outlets in Europe and in the United States, analysts who cover Deutsche Bank, who go through the books of Deutsche Bank just about, obviously not completely, but they have a good sense of Deutsche Bank. All of them came out and said, look, there's no trouble here. Deutsche Bank has had problems in the past. They have reorganized. They have cut expenses dramatically. They're following the regulatory requirements. This is bogus. What they were pointing to, by the way, in saying that, by the way, that helped actually change the atmosphere in the markets on Friday, and the markets were able to close in the U.S., a little bit higher. But the point I want to make is they made the case that it was the hedge funds that had gone in, pushed up the fear in the bank by the credit default swaps, by attacking the bonds. That's number one. And then shorting the underlying stock. I want to mention this because this is what happened in the U.S. in 2008, 2009. The hedge funds went in. They started pushing on the bonds. The credit default swaps went way up. That's a signal to the market that there's terrible problems, and they also shorted the underlying stocks. It was considered to be legal, although the market was, how do I say this, was concerned, would go to the regulators and say, how could this be legal? And then the regulators would say, no, it is legal. It's still legal today. And that is what was expected in the Deutsche Bank scenario on Friday. Again, that the hedge funds targeted what they believe was the next weak link in the system and did exactly what they did back in 2008, 2009. Short the underlying, that means betting against it, right? When you short, you're betting against it. And that they would push up the expense on insuring the bonds through the credit default swaps. The markets would be terrified and they would cash in. The reason I mention this is that there's a concern that the hedge funds are on the prowl for other banks. It's not as if the market doesn't know that they do this. It's still considered illegal, but there's more of a call right now for regulators to get involved and say, hey, wait a minute, let's look at this again. So there was no catalyst on Friday or on Thursday for Deutsche Bank to be attacked that way. That was the other part of the story. There was no catalyst. The analysts were looking for a catalyst, something specific. They couldn't find any. And I'm saying this because the expectations are they could go after this again, go after another bank. But this morning, again, good news that we are seeing Silicon Valley Bank in the news, but for a positive, and that is that First Citizens taking over a good portion of the bank. This week is an important week because we have quite a bit of legislation discussions up on Capitol Hill, both in the House and the Senate, about the banks. And the one thing I do want to point out is there's a hope that they speak on the same page, from the same page. Granted, it will be different aspects of what happened being discussed, and you're going to have the Federal Reserve head of bank supervision and regulation speaking as well, Michael Barr. That market's going to pay very close attention to what he has to say. But we know what happened last week when the Federal Reserve came out with 25 basis points and saying, look, we have price stability is important to us. We also understand the banking crisis could lead to a negative impact on economic growth as perhaps banks don't want to lend as much. Which is ironic because on March 22nd, the lending from the banks reached a high point. That's the irony of this on March 22nd when the Fed had its meeting. But nonetheless, Chairman Powell was very clear about this, that, look, we want to get back to price stability, which is 2% in inflation. And he said, we're either going to do it by raising rates or this is important, or that the situation leads to a negative impact on the economy because you have financial conditions tightening, banks may not lend as much, and the economy can be hampered. Economic growth can be hampered. But here's the point on this, that overall, he said, either way, we hope to get closer to 2%. So this is important because folks wonder, how does that happen? Well, it's something where if the economy slows, the market's doing the Fed's job for it. We don't know if it would be equivalent to 25 basis points or 50 basis points, but it is a form of slowing down the economy, slowing down demand. And that's what the Fed is looking for, slowing down demand. So in any event, this week, a very important week for inflation data, and that is the Fed's preferred look at inflation. That is the PCE, the Personal Consumption Expenditure Price Index. That's coming out on Friday. And I do want to say that right now, the consensus estimates, and remember, this is for the past month, and the consensus estimates are that inflation could be a little bit above where consensus estimates are. But keep in mind that as we look forward, and again, Chairman Powell did mention this, a number of reports are indicating that the concern over rents, new leases, that's coming down. Every industry report suggests that rents are coming down in terms of new leases, but it's going to take time to show up in the Consumer Price Index and the PCE. So we have to keep that in mind, but the Fed is obviously cognizant of that. In addition, what's really key also is about wages, to see that wages coming down, personal income easing a bit. We are seeing in the banking sector, M2, that's money supply in the banks, that is coming down. And when we look at that, we could say it's good news in the sense that when it comes down, obviously there'll be more pressure on spending. Remember, consumer spending is 70% of the U.S. economy. But when we look at it through the Fed's eyes and slowing inflation and pushing and squeezing inflation out of the system, having money supply come down is helpful. But, and here's the key, the concern right now is that as money supply comes down, and if we see loans much harder to get from more small businesses, from consumers, you add that to money supply coming down. And that is why the concern over the slowdown of the economy comes into play. So it's a scenario that plays out. It's not hitting us right now, but you have a disconnect between the equity market and the bond market. The treasury market is saying the 2-year treasury yield, those yields have come down. And the 2-year, remember, is a picture of what the treasury market thinks the Fed is going to do. And obviously, it reflects what the treasury market thinks is happening in the economy. That moved down last week. It moved down because of the banking crisis. It moved down also from what Chairman Powell said. And one other thing that happened last week, on March 22nd, when the Fed met at 3:00 p.m., the market went through a major downdraft. It had to do actually with Treasury Secretary Janet Yellen, which probably everyone knows now, contradicted herself and speaking to a subcommittee of the Senate Finance Committee. She did a complete 180, and it was like the market was, what just happened? You can't have that, especially because at the press conference, Chairman Powell made the statement that, depositors are safe, the banking system is resilient, it's sound, and depositors are safe. I won't get into the details, I think everyone knows, but all that we ask this week, with all of the testimony going on Capitol Hill, is that they're all on the same page and don't go out there confusing investors and the markets again. That is not helpful at all. So we go into this week, we will have housing related data, and we are going to have personal income related data, but we will also again on Friday have the PCE index, which is very important right now as the market is trying to ascertain what the Fed is going to do. The Fed funds futures market is looking at another rate hike either in May or perhaps June. And I have to point this out, also looking at rate cuts during 2023. Chairman Powell was asked about this at the press conference, and his answer was, well, we have a different view about it, and we do not intend to cut rates. He said, basically dismissing what the futures market has to say. Keep in mind that the futures market, the Fed funds futures market, changes. It's a dynamic, and it will change many times before we actually get, to the summer. But nonetheless, it has a pretty good record of seeing what happens with the Fed. Remember, Chairman Powell, according to the news right now, was determined to actually come in with 50 basis points last week. And if you can recall, the futures market had been pushing for 50 basis points and then switched to 25 basis points. Suddenly the futures market priced in 25 basis points, and that indeed was it. So this is the Fed having to do two jobs. One is price stability, bringing interest rates back to where they no longer hurt the economy, they don't help the economy, they're just neutral. That would be 2%, or again, about 2%. And the other mandate it has, but this is a more general mandate that leading central banks actually all try to help, and that is to maintain or restore financial stability. And that's a tug of war for the chairman of the Federal Reserve, Powell, at this point. The other thing I want to mention, that when we get to mid-April, we are looking at first quarter earnings. This is going to be important because there are many in the strategist community from the big banks, from the big investment banks, saying that, you know what, we reached the best part of earnings. We're really, how do I say this? The earnings, we kind of muddled through. It wasn't great. It wasn't stellar, but it wasn't dire either. We got through it. And by the way, the S&P 500 is up. NASDAQ is up. But they're out there talking about where they think we're headed, and that the earnings estimates are going to be forced to come down even more before we actually get into the first quarter earnings season. We shall see, because we have gone through every quarter so far since the pandemic where we've heard the same thing, that estimates are coming down, margin compression is going to be deep, that the input costs for companies remains the same, meaning hasn't come down, especially in terms of wages, which are still pretty sticky. So we have a bit to go before we get to the earnings season. It's like every day is a year in these kinds of markets. But again, keep in mind that the market gets the news first, and we have to see how the market gets through this week, especially on Friday when that report comes out, and if there are any more blow-ups in the market in terms of the banks. But at least we start off this week with positive news, and that is a bank coming in and taking over the Silicon Valley Bank. And, if we see that for First Republic, it may just help to staunch any concerns at this point about what's happening in the overall banking system. Take care. Have a very good week. We'll be back next week. Thanks again.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.